Hello, good afternoon. My name is Silei Bella. I'm the Operations Manager here at Wickham Financial and Insurance Services. Here with us today is Grant Wickham, the President and CEO of Wickham Financial and Insurance Services. Hello, Grant. Tell us what happened last week.
Yeah, thank you, Soleil. And thanks for our listeners jumping on the call, and bear with me if I cough in between this. I've caught a little bit of an allergy here, I guess, with the pollen that's running pretty high in our area. A bit of drama this past week. We saw U.S. equities hit some fresh all-time highs and then pull back a bit. We saw the U.S. The Nasdaq Composite that rose about 3%, followed by the S&P gaining about 1.6%. Now, what really rallied the most, but then gave it all back and then some, was the Russell 2000. That's a small cap area. So that surged about 3% all the way up into the Wednesday's CPI report. And then by the end of the week, it was down 1%. So we saw 8 out of the 11 S&P sectors were negative, but we did see technology stood out. That was the driver. That was up about 5.6%. Within that technology area, we saw Apple really spike about 14%, leading that sector. So if we look at commodities and bonds, we saw crude oil jump about 4% due to some declines that we saw in the global inventory forecast. We did see yields pull back and bond prices move up. Now, that was the best performance we saw since December of last year, when we saw maybe a more appetizing CPI report, meaning that maybe inflation is coming down. If we look at the monetary policy, we saw the FOMC keep interest rates steady as projected, but they did update their forecast for some rate cuts. Now, was it 6 originally thought, or 3? Maybe it's more like 1, maybe none, but I think they're heading towards 1 at this particular time. Consumer sentiment in labor markets, we did see the U.S. Consumer sentiment decline in early June due to some inflation concerns. If we look at international markets, we did see the MSCI EFA. That was off. That's the developed markets. That was off about 2.5%. So why? U.S. rallying, international markets down, developed. Well, we're seeing some geopolitical events, especially over in France with their elections. If we look at Bank of Japan, we did see the Bank of Japan keep interest rates unchanged, but did surprise some traders, but not specifying their bond purchase or their reduction plan. If we look into this week, what's going on? We got retail sales, we got industrial production, housing numbers, so global flash PMI numbers, really a good bit international from the central banks, China, and the G7 meeting that's going to be in Italy. Select.
Thanks, Graham. As the election approaches, how do you see the markets being affected?
Well, if history is any guide, right, it's no guarantee it's going to repeat itself. It probably shouldn't be very dramatic. Now, everyone's got their own opinion, so I don't think it'll be emotional, but I don't know that's really going to drive the market. The market's anticipatory. The market's not as political as I think many think. And if you look at history, it really didn't matter if it was a Democrat, Republican, majority, minority. The market still moved up over time. Now, I would not say that we could not get some headline and volatility from what's going on, because it's emotional, right? But I don't think it would be enough to really pull the market back in any dramatic fashion. But just keep in mind, the markets have done extremely well. It's been very concentrated. So if you start to see certain sectors pull back that might pull back or bring the market down a little bit, maybe at the same time we see some of the underperforming sectors start to move up as we get closer to election, so we get closer to hopefully the first Fed cut.
Thank you, Graham. And thank you everyone for joining us today. Hope to see you next week. Bye.
Take care.